So like we are starting from establishing direct material standards. So as you know, the standard cost, whatever we find, is per unit wise. Okay. So now, if you want to like calculate the standard cost of a material or per unit cost of some particular thing what you're going to produce, so you should keep three things in your mind. So or you should like take three considerations. Okay, like when you want to establish a standard cost for direct materials. I'm speaking about direct materials which are directly involved in the production process. So first you should see how much, first you should see what quality of metal it is. That means, when you make some product, there are like raw material of different qualities. So depending upon the quality, suppose this is first quality, this is second quality. Like you see, when you buy some chair, premium chairs, non-premium chairs. So premium chairs, when you want to buy premium chairs, they make it with some premium quality materials. That means more durable ones. And non-premium means in the sense that will be of lesser cost. That will be of that will be of lesser cost and less quality. Then how much quantity you need per unit of output. That means suppose I want to make 100 chairs. So for one chair, how much quantity I require, how much mold I require, and then price per unit of material. That means for one chair, how much is the price of that material which I am using for making that one chair. That means I should see the quality. So suppose let's say my product is chair. I should see the quality. So the direct material what I'm using is mold. That mold is nothing but that will be some plastic raw material. So first I'll see the quality, then I'll see the quantity per unit, then I'll see what is the per unit cost or the cost of the mold to make one chair. Cost of mold to make one unit of chair. So that can give me a quote, or that can give me the cost for 100 chairs or 1000 chairs, whatever I make. Correct? Now, so these are the three things what we have discussed. So what we need to ensure is the quality should be of the best. The quality should be the best one. But see, it depends upon what product you are making. It depends upon what kind of product you are making. So quality would be based upon that. See, you are in such area whereby that area doesn't demand premium quality products. Like I'm not saying if you are in Banjara Hills, if you stay in Banjara Hills or Jubilee Hills, many people, this is one of the most what we say posh kind of, that's a slang they use, or neighborhood whereby all rich people of the Hyderabad city they reside. So there they would be going for premium quality ones, not for the non-premium. And if you are in some area whereby like the, the, the crowd is of working class, more often they'll go for the non-premium one. So it depends upon that, and based upon that you have to get the quality, and then quantity, how much you want to make, and the price you should see at very less cost how much metal you can get and you can procure. And also the cost of delivery also is important to be considered. Okay, that also adds up and is a component of cost. Okay, now so first you have the direct see, when you want to make a chair, so first consideration what you have done is direct material. Okay, quality, quantity, and cost. And then comes labor standards. So again, how many labors you want and what is the wage rate, at what price you can get a labor. It's upon you how you can negotiate, or how you can get some contractors who can get cheap labors for you. And like I know that's not a good mindset with which many companies work. They want a labor to work for more hours at less cost. They want to save cost, but the thing is like that's unethical, but it's happening. So then comes the direct labor. And then what next consideration is nothing but the overheads, because till here it is material, and then comes the conversion of material. So conversion cost. So in conversion cost we have direct labor and overheads, and again overheads are variable overheads and fixed overheads. So you know overheads are indirect expenses. So labor and overheads come make conversion cost. So these three things when you have per unit wise, you get the standard cost. Finished. So all these things I've explained you. And then the biggest problem with overheads is, so I have already told you, chair is my product. For making chair I have material, I have labor, and I should consider overhead. But the problem with overhead is it is always in total amount. Let's say if I want to know the factory rent, so factory rent you cannot get. See, you are finding out the standard cost of making a chair. That is 1 unit or per unit cost. For per unit cost, you can get quote for this and quote for this, because you are paying $20 for 1 hour to a labor. I'm saying labor hours. Okay, you are getting a raw material. The mold is costing you $30 for making one chair. Let's say a small example, but factory rent you're paying $10,000. That's a total amount. It's not a per unit amount, but you can convert that $10,000 into 1 unit. So how will you do that? You should see for allocation base. That you'll be learning in details in absorption costing. So allocation base is nothing but there are 2 standard allocation base followed by every cost accountant or budget, or the ones who's preparing a budget. Those are nothing but machine hours, that's the allocation base, and labor hours. So machine hours and labor hours are the 2 allocation base. Then what would you do is $10,000 is the factory rent. You can take 1,000 hours the machine is working, 1,000 machine hours, or 1,000 labor hours. So how it goes? So then you get $10. So $10 per machine hour is the factory rent. That means if 1 hour the machine works, $10 is what you're going to spend. 1 hour if a labor works, $20 is what you're going to spend. One chair if you're making, $30 of raw material you require. So you have raw material, you have labor, and then you have $10 of overhead. Altogether, one chair is costing you $60. This is what is the quote. Okay. So or else if not machine hours, then labor hours. For one, if suppose it takes 1 hour to make a chair, let's say it takes 1 hour to make a chair. So for 1 hour, 1 hour of labor work, $10 is what is your overhead, which is nothing but the factory rent. Okay, so in that way you can estimate. So $30 is the raw material for 1 unit of chair, or which can be produced in 1 hour. In 1 hour you make 1 chair, let's say. In 1 hour you make 1 chair, let's say. So $30 of raw material, $20 of labor payment. If you make for 5 hours, let's say, then also $30 of raw material. Okay, but labor charges you will be considering per hour wise, and $10 is the overhead for 1 hour of machine work or 1 hour of labor work. So that totally gives you $60 standard cost. That's what is the formula. So now we will do one question and we'll practically understand what I'm saying. Okay, we'll do a question and we'll understand the concept here. But before going into question, we'll discuss some points. So you know, like as the steps in calculating predetermined overhead allocation rate. So company budgets It's cost for fixed or variable overhead. There are two types of overheads I said. Management determines the appropriate allocation base, which I said labor hours or machine hours. These are the appropriate allocation base for fixed and variable overheads. So frequently they use labor hours and machine hours. Company decides how much output it will produce during the coming year. How many units? As a function of that output, how many machine hours or labor hours, whichever it is using as an allocation base, it plans to use during the year. Then budgeted monetary amount of fixed or variable overhead is divided by planned activity level. As I said I had taken $10,000 as my factory rent and I divided by 1,000 labor hours. Let's say, because I have already estimated that my laborers are going to work 1,000 hours only. That is the capacity what they have. That means that much total I will take to produce the entire units of chairs, 100 or 1,000, whatever chairs I want to make in a year. Let's say you get each unit. So alternatively, budgeted monetary amount, which is the numerator, and the activity level, the denominator, can give you the overhead for one unit of chair which you are producing for one for 1 hour of labor or 1 hour of machine work. Okay. So variable manufacturing overhead, you know what that is? Like a very good example can be what can be a good example for this? Like the great what happens? Yeah. So let's say if I see variable manufacturing overhead, what can be a good example for variable manufacturing overhead? So if I want to say variable, what kind of industry we can take into consideration as an example? Any clue? Yes, Zarina? Hello? Hello? So you can take, I can take some example like what can I take? Yeah, so any clue if you have an example? Indirect labor. So indirect labor we are paying per hour wise, not in total. Okay. So we decided to pay per hour wise. So how many hours he works? He works for 10 hours. Or, so per hour is like $10. More and more hours he works, more we pay to him. So that is variable, correct? Any other example if you have? Hello, Zarina, are you following? Any more examples if you can give? Hello. 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 Variable overhead examples. So like this can be a very good example. Or there can be some labor who are involved in loading and packing and handling. So we pay them hourly basis. That is also an example of indirect labor, and that is the example of variable manufacturing overhead. See, electricity charges are semi-variable. Why? Because some units are fixed. Like suppose, let's say, so for 100 units they have given you free, the government. More than 100 units if you use, per unit wise they'll charge. So more units you use, more you have to pay. That is an example of semi-variable cost. But I'm speaking about variable manufacturing cost. So this is a good example, packing and handling labor. Okay. And then more examples if you can get, you can get it, you can go for that. Any other examples if you have in your mind? Then comes the fixed manufacturing overhead. That is nothing but factory rent, factory supervisor salary, etc. Okay, that we can divide with activity level. Now we are going to do a question to understand this. So you can read, start reading this question, Zarina. Are you following, Zarina? I'm just like not able to hear your voice. Hello. 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 Yeah. Are you reading this question? So total manufacturing overhead is budgeted to be 9 lakhs for the budget year. So this is the total manufacturing overhead, which is a combination of fixed manufacturing overhead and variable manufacturing overhead. So these are the two overheads. Okay. So they have given like two divisions here. So now 9 lakhs is the total manufacturing overhead budgeted. That means they have budgeted that they are going to they are going to expect $9 lakh for manufacturing like goods, and they are going to spend this much as an overhead. So they have already estimated that, or they have already budgeted that. Okay. Now 6 lakhs for fixed manufacturing overhead and 3 lakhs for variable manufacturing overhead. Okay. Now output based on master budget capacity utilization. See, master budget is nothing but the budget in which you make all the budgets like sales budget, production budget, material usage budget, and cash budget, and then like overheads budget. So you make all the budgets. So based upon that, output based on master budget capacity utilization is 5 lakh units for the year. So this many units they want to make. Okay, this many units they want to make. So see, variable overheads can be of many kinds. Variable manufacturing overheads, variable non-manufacturing overheads. So in that I can say sales commission. Very simply understood. Sales commission is a variable non-manufacturing overhead. But variable manufacturing overhead can be what? Like packing and handling of materials. To those labor we give per hour basis wages. That's one of the examples, and I gave you like one example more, like some labor is working in our company not on manufacturing activity, and we are giving them some hourly basis payment. So more hours they work, that much they will be expecting the payments from us. That's a very good example of variable manufacturing overhead. Okay. So any kind of overheads whereby, or I can say gas bills, which we use in manufacturing. Gas bills are like how much gas you use, that much. Water bill, water bills, because in industry they require a lot of water. Okay. And electricity, I said that is semi-variable, not completely variable. If in some countries they give some units free, and above that they charge, it semi-variable. If they don't give any free units, then it's a variable manufacturing. So here the standard for variable overhead is like 3 lakh is the variable overhead divided by this many units. So this much dollar per unit is the standard variable overhead. So here what has happened is they have directly given how many units they want to produce. So we directly divided with number of hours and we got variable and variable overhead per unit and manufacturing overhead per unit. That is this much. Fixed overhead per unit. So the variable overhead per unit is 0.60 cents or dollars, and the fixed variable and the fixed overhead per unit is 1.20. So variable manufacturing overhead per unit is equal to 0.60. Fixed manufacturing overhead per unit is equal to 1.20. Okay, which you have directly divided your overheads with the number of units. Now, the standard cost calculated per unit will be used to apply overhead cost to actual units produced. And that is the information given. So now production is not planned to take place evenly throughout the year. The initial production budget for the first quarter calls for 40,000 units to be produced. So first quarter we want to make 40,000 units. In total year we want to make 5 lakh, but first quarter this much. In January and like February and March, in the first quarter, these are the 3 months whereby we want to make these many units. Now we'll divide as per that. So division is not required because we have already found out the per unit variable overhead per unit. So we'll directly multiply. So this much is the variable overhead per unit multiplied with number of units. We got the amount in all the 3 cases. This was variable and this was fixed will always be fixed. Okay, fixed budgeted fixed overhead. So budgeted fixed overhead is like $50,000 per month. It's monthly, so that is monthly given. Okay, it won't change. So your total overhead is this, correct? Now let's go ahead. So now assume that was just the first draft of budget. Following meetings between senior management and the plant manager, it has been agreed that the planned activity, that is production level for year, needs to be increased from 5 lakhs to 6 lakhs. Now they want to increase, and again the budgets they have made is more excess production in the coming months. So now 6 lakh units into this will give you this much, and an increase of 60,000 from when compared to 3 lakhs. And also fixed will always be fixed, that won't change. So 6 lakh is fixed, so 9 lakh 60 is now your this one total overhead. Okay, so note that the total budgeted fixed manufacturing overhead stayed the same, and only the budgeted variable and total manufacturing overhead increased, because fixed is always fixed, that's its nature. The standard for variable manufacturing cost contains this much per unit, but the standard for fixed overhead cost is this much to this much now. Okay, because now the number of units have increased from 5 lakh to 6 lakh, so $1. Now let's come, and then you have this budgets, like this many you are going to produce, and these are the amounts, and this is the total. Okay, that's what it is. This one you can go and do as a homework. Serena, just go for this question. I'll move to the next topic. Serena, are you able to hear my voice? Hello? Are you able to hear my voice? But you are not answering any time. No, I am not hearing your voice. Really? Okay. Then you just go to the column and we'll go for the next chapter, forecasting. Okay? Yeah. Please confirm me when you are done with the question. I'll go for the next unit.
Okay.
Yeah, okay.
Done, sir.
Okay. Now, we are going into the next topic called forecasting technique. When I speak about forecasting technique, I'm speaking about future estimate or forecasting the future or predicting the future. Okay, the term can be used as predicting the future. So, if you want to predict the future, you can do that in the world of finance with some techniques called forecasting techniques. Okay, so we'll see some of the techniques here, and first we'll go for the mathematical model. R is equal to 1000x is a function whereby this is your revenue, okay, and this is the fixed number, and this is x would be number of units. So let's say 1000 is something which is fixed. X you take 1, you get 1000. If you take x2, you get 2000. So as the x changes, the revenue changes. This is the revenue function. If company has a product that it sells for $1000 each, so this so they always have fixed their price. So the price here is $1000. It's a fixed price. Now you increase any number of units, you get the price for the total units. Isn't it so? Or the revenue or the sales for total units. So if I have $1000 which is fixed, for 1 unit the price is 1000. For 2 units it is 2000. Okay. Now we'll enter into the linear regression in forecasting. So linear regression is nothing but, I'll write the equation y is equal to a plus bx. It's a regression equation whereby a and b are constants. A is called y-intercept. I'll give an example even. B is called slope. Let's take two equations, risk and return. So I'll write return here, I'll write risk here, that is I'll take it standard deviation, and here I'll take returns. So 0 and then like 2, 4, 6, and then here like 1, 2, 3, let's say. Okay. So from here, like let's say this is the risk-free rate. That means for no risk, you will get 2% returns. For taking zero risk, you'll get 2% returns. So my line would, my point is here. And then for 1% risk, I get 4%. For 2%, 6%. Let's say 3%, 8%. Let's say. If I draw a line, it goes in this way. This line shows a line of linear equation. It's a linear equation line. That it shows linearity. Why? Because it's a straight line. It shows linearity. Okay. Just a second. So this is a linear equation. It shows linearity. It's a straight line, and so here the y-intercept is always a constant. So y-intercept would be 2 here, which is a. Then comes b. B is slope. Slope is nothing but change in y-axis divided by change in x-axis. Change in y-axis by change in x-axis. So let's say if you move from 2 to 4, so 4 minus 2 divided by, if you have taken like risk, that means no risk, 2 was the returns. If you are taking risk, that means 0 to 1, so 1 minus 0, so 2 by 1 is 2. Okay, that is the slope. If you move further, so it's like you get this, so 6 minus 4 by 2 minus 1, so it is 2 by 1 again. So the slope is constant or not? Please tell me. Again you move from here to here. you get returns. So again 8 minus 6y, 3 minus 2, so 2 by 1, 2. So slope is that, it's constant, and this x is nothing but it's called a dependent variable, sorry, independent variable, and this y is called dependent variable. That means as you change x, y would ultimately change. So what you can do is, here I'll just put things y is equal to a plus bx, and we'll see how we can forecast. Okay, how we can forecast with the given equation. So let's say a is 2, b is 2. So the risk is first 0. So as the risk changes, that means as you move further, the returns are changing. So your returns, which is y, which is a dependent variable, is dependent on this independent variable called risk. So your returns are dependent on risk, correct? Risk returns are dependent variable and risk is independent variable. So 0 into 2, 0, 2 plus 0, 2. So your returns are 2. Of course, we got. Again, I'll take the second case. So here the next case, I'm changing the risk. Okay. So 2 plus 2 into, like I have gone from 0 to 1. 1. So my return is 4. So when I increase the risk, my return is increasing. And when I plotted the graph, I got the same thing. What I mean to say is, now how to forecast the future and how we would be using this regression equation for forecasting the future. Now a question comes to you. If this is the scenario given to you on the graph, what would be the return if 10% risk is taken by the company? Did you understand what I mean to say here, Zarina? Hello?
Yes.
Yeah? What I'm asking is, this is the thing what you're seeing in the graph. But if I ask you, what is the return of the company if they take 20% risk or 10% risk? For that, you don't have any figures on the graph, but we can forecast that. How? See, A is constant, B is constant, X is 10%. So 20. So we should get 22% returns. Finished. So that is what is the what we say, usage of regression equation. Okay. So here is the regression equation given. I have come to this. This is done. This is done. And here, what is line of best fit? When all your points, 1, 2, 3, all points lie on the same line. This is called line of best fit. If your points lie above or below the line, then you know all the points cannot be joined. So one line, so we'll be making multiple lines, but we'll be seeing the line which has more and more number of points. That will be called line of best fit. Okay, then I'll discuss about the time series right now, and we'll go ahead. See, what is time series? Time series is nothing but over the time period of some. See, time series is not a simple concept and not either a small concept. It's a very vast concept, but that much scope is not there for you in your syllabus. So what does time series say? It shows the history, or it shows the trend and the fluctuations in some phenomena. For example, these are the sales and these are the number of years. You can see over the number of years the sales, how the sales figures or how the sales have behaved. You can see this is a line of best fit whereby maximum points lie, but there can be some fluctuations also seen. So this is a forecast of the sales for these many years, and based upon this you can again forecast for next 10 years. Okay, so this is done casual forecasting. Okay, I am going to wind up this unit also today. So multiple regression analysis in casual forecasting. See, multiple regression. Okay, what is casual forecasting? Casual forecasting methods are used when value being forecast is affected by some other value. So, price and demand. So when price increases, demand decreases. There's a cause and effect relationship or not? Of course. The cause for demand going down is the price going up. This is a very well understood cause and effect relationship. If you see advertisement and sales, the more advertisement you do, marketing promotion, the more sales happens. Correct? That's a cause and effect relationship. Then comes the multiple regression analysis in casual forecasting. See, multiple regression analysis, nothing but I can say, like, instead of one variable, you have multiple variables. For example, if I speak about India's GDP, so India's GDP may rise due to many factors. What happened is, like, in case of the demand, in case of the the demand, which is a dependent variable, and price, which is an independent variable. So when price increases, demand increases. Do you think demand can increase because of price only? When price decreases, demand increases. When price increases, demand decreases. So what happens is, the relationship is negative relationship. When price increases, demand decreases. But let's say this is only one factor which you have seen, but the demand in the market can decrease due to other factors also. Am I right? Please tell me yes or no. Yes.
Yes.
What can be other factor?
Supplementary product.
Sorry.
Sorry, we have cleaning supplements available better quality than the manual decrease for display.
I'm not able to hear even a single bit because your voice is not clear. See, what are the other factors which can affect demand? Madam, can you give me the answer?
Supplement. Yeah, supplement is the supplement products are better than the demand for display uh, uh, is.
Voice.
Supplementary products.
Yeah, like, complementary, supplementary, substitutes, decrease in income. Yeah. Yeah. See, price is increasing, demand is decreasing. Decrease in income can also, like, reduce the demand. Huh? Okay. Correct. The income levels of a person is decreasing. Taste and the consumer is fed up because of the product. So taste and preference. So what I can do is, I can take demand as my dependent variable, and I can take some variables which are like independent ones. I'm not taking only one variable, I'm taking more than one variable. I'm not taking one variable, I'm taking more than one variable. I'm taking multiple variables. So I can take price, which can affect demand. I can take income levels. I can take decrease in income as one of the factors. I can take taste and preference. I can take more variables like substitutes. So all these things, correct? So then it becomes a multiple regression equation. Okay. Now, then what happens is, like, multiple slopes. That means then you will be getting more lines, not only one line. You'll be getting multiple lines. These are the axes. You'll be getting lines in this way. Okay. You'll be getting a three-dimensional figure. Why? Because you have taken three variables. Am I right? And one point I have to explain you, whether there or not there, we will go. Okay, we are done with this chapter. Nothing more. if you come across any, as per me, I have explained everything. Yeah, done. Okay, so please go through this concept. We are finished, and then tomorrow I'm going to start a new topic, new chapter called learning curve in forecasting. Okay, and advantages, disadvantages, benefits, and all we will discuss. Regression analysis is a quantitative method, of course. It's a statistical method, and it is very helpful in making forecasts. Is a good tool for budgeting and cost accountants. They use this for forecasting, but the thing is, like, it depends upon historical data, and if the data is not right, then you can like make some mistakes. Historical information what you get is always not correct for predicting the future. Casual forecasting, the usefulness of data generated by regression analysis depends on choice of independent variables, and it is not like what independent variable you're taking is always the one. Because I'll use a word called causation. See, what do you mean by causation? Causation is, let's say, uh, what can be a good example of causation, if you can tell me? Let's say there is one boy, he got a fever. Okay, there will be a cause of this fever, correct? The cause is got exposed to, got wet in rain. Correct or wrong? Hello? See, yeah, the causation is the boy got
Yes,
the
sir.
fever due to, as he got wet in the rain. But the boy can get fever. He's in a car. He's in a car, and still he got the fever. He's in a car, traveling in a car. Still he got a fever. Maybe he exposed to some other person who had a fever, viral fever. You know, viral fever is what? If you get it now, everyone is getting viral fever these days. Why? Because you are in contact with some person who has already got some fever, and that virus has entered
Get
into
in
you.
contact with someone.
Yeah. So this can be a causation for him for this fever, not this. Am I right? See, what is the direct cause for him to get the fever? He got wet in the rain, or he was in car? He got wet in the rain, correct?
God waiting room.
Yeah, that is it. So there can be
Yes.
reasons, but there can be one cause. There can be various reasons, but there can be only one cause. Okay, like ice cream. Like, let's say, summer heat. Summer heat. Increase in sale of ice creams. Okay, and people getting sunstrokes. People getting sunstrokes after eating ice cream. Strange reason, correct? I can say because of summer heat, people are eating ice creams and the ice cream sales have gone up. This can be a causation, correct? But people getting sunstrokes after eating ice cream, can you say that that's not the cause, correct? People are coming
So,
out in
yes.
summer days to eat ice cream, and they're getting sunstrokes. So sunstroke is only because of summer heat, but not because of ice cream. So there's no causation there. That's it. Okay, so tomorrow we'll start learning curve. Thank you.
Okay.
Yeah, thank you. Yeah.